And that is, it's not gold going up, it's paper currencies going down. These levels on the ratio are just absolutely crazy. And as gold goes up, silver will go up twice as fast to bring that ratio down to something which is, if you like, more sensible. Yeah, 2024 was interesting. 2025 is going to get even more interesting.
Our goal was down, falling stock market, recession, maybe a financial crisis. There could be a financial crisis early in Trump's first year. The fact that these stocks are down so much shows you how negative the sentiment is in gold. But how negative the sentiment is in gold, that's how positive it is.
And to push silver below $30, it was, this is what they've been trying to do. And I think you'll see it turn right back around because all of those short positions get covered and it goes right back around. What you will see is massive managed money selling and commercial banks taking the other side of that and going long. And, this is an environment where this is as big of an opportunity as I think you'll ever find in precious metals because nothing has changed whatsoever. Nothing.
In today's news recap, gold holding $2,600 ahead of shortened holiday trading week. Despite ending the week in negative territory, the gold market managed to hold critical support at around $2,600 an ounce, even after the Federal Reserve signaled it would slow the pace of rate cuts in 2025. Gold struggled during the last full trading week of 2025 as investors prepared for the Federal Reserve to announce a hawkish rate cut. As expected, the central bank cut the Fed funds rate by 25 basis points. However, updated economic projections revealed that forecasts for interest rates, also known as the dot plot, indicated only 2 rate cuts next year, putting rates at 4%. In September, the Federal Reserve had forecasted 4 rate cuts for the new year. Analysts note that gold could still face challenges in this environment during the shortened holiday trading season. Commodity analysts at TD Securities said in a note Thursday that the path of least resistance for gold could be lower in the near term. While we do not expect a rout, given uncertainties surrounding Fed policy, should inflation continue to be higher than expected and the economy start to slow at the same time, new geopolitical risks, and a renewed round of central bank buying, somewhat lower prices are still likely in the near term. It would not be surprising to see prices drift down to the November lows of $2,537 per ounce, the analyst said. However, other analysts see gold caught in a tug-of-war between the Federal Reserve's monetary policy and geopolitical uncertainty. Gold managed to hold critical support Friday after the U.S. Congress was unable to pass a spending bill before the holidays. The government is once again on the brink of a partial shutdown that will affect everything from border enforcement to national parks and furlough up to 2 million employees. Now we'll show you the best clips of the latest interview, but first hit the like button, smash the subscribe button, and
I have one or two friends, not very many, in the LBMA, and I was talking with one of them some time ago, and he admitted that he never ever looks at economic factors. He doesn't understand, sort of money, all that sort of stuff. I mean, he just trades the stuff. He was making some pretty good forecasts on the basis of his experience as a trader. But I think this is really what it's about. We're moving from the days when, you could just trade gold. If you're a bullion bank, you're probably running a short book. So what you do is, you trade it and, every now and then the punters, hedge funds get a bit overextended. You can bang it and trigger all the stops and get your position back and all the rest of it. That's not happening now. And I think that's the big difference. And the reason it's not happening is because there are bigger forces at play. I think it's probably surprised a lot of people that despite the price rise, the Chinese are continuing to buy. And so are other central banks. So what's all this about? Well, I mean, the answer is quite simple. And that is, it's not gold going up, it's paper currencies going down. And this is very, very important. It's very important to get this message early, because when the general public finally realizes that it's not the price of eggs or the price of coffee or whatever going up, but actually the purchasing power of their currency going down, then the currency is doomed. And when the general public wakes up to it, I can tell you the dollar, sterling, euro, yen will all be a lot lower. Now, I put it that way rather than saying gold is going to be a lot higher, because if you think as an investor, you look at gold and you think gold's gone up. I mean, as we talk, I don't know what it'll be when this is released, but as we talk, it's had a good day. I see it's up $18. It's currently trading at 2,712. Challenging the levels we saw, sort of 4 weeks ago. If it breaks that, then it's going to go and hit new highs and so on. But do we really want to pay this much for gold? I mean, perhaps we should hang on and wait for a decent shakeout. Too far. But the point they miss is it's not gold going up. It's the currencies going down. Now, obviously, nothing goes down in a straight line or in an even tempo. But I think if you understand that, then you understand that really what your strategy should be is not trading it, but actually accumulating it, and accumulating the physical, not paper. Now, this is a very, very important point. And of course, the whole of the investment industry has a difficulty here, because gold is not a regulated investment. So how do you get it past your compliance officer? Well, the answer is you go out and buy ETFs. But your problem with the ETF is you don't own the gold. And worse than that, not only do you not own the gold, you don't actually own the shares in the ETFs unless you have specifically decided to take delivery of certificates. Now, this is a very important point, because the owner of, or if you like, the owner of the certificates, in effect, is, the clearinghouse, the intermediary, the big boys in the middle, basically, who guarantee settlement, Euroclear, whatever. And why have they got it? Well, I mean, the answer is quite simple. You've got a huge, great derivative mountain, which is absolutely enormous. And the fear is that at some stage we get a crisis and that could be jeopardized. So what they want is they want your stock